are things going? The market had an interesting day, and I hope you had a good one as well. Um, let's hope that you didn't get caught off guard by Powell's hawkish rhetoric. I mean, I'm not saying that I predicted it, but I was cautious about it. I mean, it was one of the few reasons why I didn't enter a short dollar position, no matter how tempting that long euro US dollar trade looked or the short US dollar Japanese yen trade looked. When the dollar is in its move up on a strong US economy and strong inflationary data, it's hard to bet against it and be right. So I'm kind of glad I stayed away from that one. Um, but let's start off by talking about the important market developments. Powell's speech was by far the most important thing that happened in the markets today. He mentioned clearly that judging by the way the signals in the economy are, there's no reason for them to hurry cutting interest rates. Now, this is a bit of a convoluted way of saying that the pace of interest rates may come down slowly. We'll talk more about that later, but it's obvious this means it's hawkish. I mean, it's clearly hawkish. And PPI coming in at 0.2% month on month, which was more than last month, and initial jobless claims coming in at only 217K for the last month when the consensus was 223K, indicates that the labor market is doing reasonably well. The weak report that we got earlier this month was probably solely due to the hurricanes and a couple of strikes that happened across the country. But I mean, initial jobless claims again, good for labor market. PPI again, tying back into the CPI narrative. Powell only increased it that inflation is well and alive. It's not dead like people were claiming a couple of months ago. I heard some people were even saying that deflation is actually a bigger threat now. It goes to show that similar to politics as well, that don't count everything out until you've actually seen the data. Things here change on a monthly basis. I mean, in August, the market at one point of time in August was pricing in 150 basis points of cuts. We barely might have had 75 basis points. And if I'm not wrong, I wouldn't be surprised if you ask some Federal Reserve members, they might have been happy doing 50 this year, honestly. And um, judging by the market pricing, we had only 45% chance of a hold in December, which is incredible. I mean, we've come a long way in this week. As a result of the data and the speeches, dollars up, short end of the yield curve is up. Long end did come down a little bit. Maybe it's a bit of a relief rally, but we'll need a couple of days to check things out before confirming that bond vigilantes are out of play. I don't like to make sweeping statements like this. It's better to get some confirmation both on the price side as well as from data or something like that. I mean, yeah, and Bitcoin also took a bit of a breather today. Equities again down. I mean, the whole narrative today was shifting back a bit more towards monetary policy, and the post election euphoria might have had a bit of a breather. Honestly, a much needed break, I would say. So, if you're long on equities, don't be too stressed, in my opinion. I know today's messaging was a bit hawkish, but the technicals definitely did play a role as well. We should wait a couple more days to confirm how much the market will price in. I mean, I'll discuss more about this later. But for the time being, those are the important developments in the market. And yeah, let's move forward now to seeing what are the important events for Friday. So, as you can see on the screen right here, we have two major events tomorrow. I mean, there are many events in the day, but I tend to focus on the major ones as well as on the jurisdictions that I tend to focus on. So, the first one that we have, is honestly gonna be in an hour or two, honestly, is British GDP month on month data, which comes out at 2 a.m. on Monday. All times are Eastern Standard Time, by the way. Economists estimate is 0.2%, which is honestly reasonable, like especially for UK. The economy isn't as robust as America's, so 0.2% isn't a bad number. But I would say, judging by the current price action of the pound and British yields, it seems like the market pricing may be slightly lower than forecast, especially since on Tuesday we had a weaker labor market data. Again, this is rather important right now, I would say, GDP data, because if the number is higher than expected, then it would give reason to the Bank of England that, hey, like the economy is doing fine. I mean, inflation's not entirely defeated, especially because they tend to have higher service inflation. So the pace of rate cuts would reduce, pricing would reduce, which would cause British yields and the pounds to rise. And equities, I'll be honest, would be mixed. And if we get a weaker number, then yields would drop, pound would drop, and equities would probably rise in that scenario. So out of a five, I would say for the British markets tomorrow, this data is like a three to a three and a half, I want to say. And second, coming back to North America, is the US retail sales. It's for October, and it comes out at 8:30 EST. Economists estimate 0.3%. Again, very strong. Like, and given the pace of the dollars increase as well as the yields increase, as well as all the economic data that's coming out, as well as the hawkish rhetoric that's circling around the narrative, I have to say that the market is probably pricing a higher than expected number. So don't be surprised if we get a 0.3% tomorrow and the dollar and yields actually drop on that. So don't be surprised. Like, this is something I want to say. It will be similar to what we saw with inflation. Again, a three and a half out of five, pretty important, because this gives us a sense of the strength of the US consumer. And again, if the number is higher than expected, like a point 0.4, point 0.5, I don't know if you're going to get a point 0.5, but if we do, then it means that on all fronts, the US economy is strong. And then, even though the yields and the dollar may seem to be technically too high at the moment, it doesn't matter. It's going to go up. Equities may be a mixed bag, but on the higher side, I want to say, because I think the growth story may outperform the hawkish worries on inflation. And if we get a low number, then maybe the opposite would happen. Equities may still be a bit protected, in my opinion, in that case, but let's see how it goes. So now that we know where the assets are trading and what were the major drivers in the market on Thursday, as well as the important events to look out for, particularly data releases, because we don't have any major speeches tomorrow. Honestly, I'm glad we had enough of speeches this week, and the speech today did move the markets quite a bit. So I'm kind of glad at least we don't need to worry about that front tomorrow. But now that we have that out of the way, we can look at analysis. Today, I'll be analyzing two jurisdictions, the first being the United States and the second being the United Kingdom. Now, when we talk about the US today, obviously, it like a lot of it was mentioned in the important developments, and this is just a heads up. Like, from time to time, like a lot of what happens in the US will naturally trickle around the world simply because of the size of the economy, and more so now because they just had an election. A lot of economic data is coming out. The chairman of the Federal Reserve just made a speech. So US just tends to have an outsized impact on the world, which I mean is pretty obvious. But everyone, if you look at any newspaper, all that people are taking out is like the PPI report, the initial jobless claims, and that one sentence of Powell that nothing in the economy signals that we should be in a hurry to cut interest rates. And no doubt that is probably the most important statement. But I mean, the whole point of this analysis is to try and find a few more nuances and like peel the onion a little bit more. So I think he said two more important things. The rest of the interview was about central bank independence, and maybe we can cover that some other day. But with regard to markets and policy, the two other things he said was the first being about the neutral rate. For those of you who don't know what the neutral rate is, the simplest definition is it's the rate at which monetary policy is neither expansionary nor contractionary on the economy. So it's like a nice balance point. You can search it up and you'll get a lot of economic definitions with a lot of maybe fancy words here and there. But I think this just gets the intuition right. And I think with anything, getting the intuition right is the most important thing. You can learn the technical jargon later on. But he said that finding the neutral rate is important, and the best way to do it, because the economy is so strong, inflation is still like elevated rather, and the labor market does like he doesn't want the labor market to cool more. So he said the best way that they can go down to neutral is carefully and like slowly, basically. So it's like he with patience and care. So he was basically stating that he doesn't want to just cut rates really quick and risk going below neutral, because this is Powell way of also mentioning that probably inflation is not where they really want it to be, although he didn't explicitly say it. Because if you reduce rates below neutral, even for a month or two, with the lags that monetary policy operates with, you're going to end up in a really bad situation where the labor market is okay, but inflation suddenly ticks up again. And if you have heard Powell and any central banker, their worst nightmare is the 1970s stagflationary situation where the economy doesn't grow that much because rates are rather elevated and inflation isn't coming down because of a central bank policy error. So I'm determined that they're going to avoid that, like, because it's the worst thing that central bankers can end up doing, like allowing the economy to go into a stagflationary situation by cutting too quickly and realizing that, hey, inflation's still there. So that was one thing, which means that maybe the pace of rate cutting is slow. I mean, that's why if you look at it right now, yesterday the market was pricing a 17% chance for a rate pause in December, and the other 83% was for a 25 basis point cut. Today, that number is at 42% for a rate pause. That's a massive increase, and we could even go higher, honestly. Although I do think they would most likely cut, but it could well be possible that they end up holding with a lot of uncertainty in the market. So that is also possible. The second thing he said was less to do with monetary policy, but also it gave us a view into how staff at the Federal Reserve and policymakers at the Federal Reserve work a bit differently. He said staff has to be nimble, agile, quick footed, similar to the market. They have to get ready with all the important details and like keep pricing things in. So everything that's out there, the moment it comes out there, the staff gets to work. Whereas policymakers need to be more restrained, more patient, because their decisions have a massive impact. So they need to review a lot of this data and give out outputs. And you might be like, why are you even talking about this? But I think it's important because it gives us a view into why the market gets the Fed's decisions wrong so often. I mean, you look at any one of the curves that the market's been predicting, they have been wrong again and again about the rates. I mean, because even the Fed doesn't know what they're going to do, because fiscal policy, you don't know what the Trump administration is going to do exactly with regard to tariffs and the other policies. And on top of that, you don't know how economic data is going to come out. So policymakers tend to be more calm, collected a lot of times, and sometimes they do make mistakes, of course, but they tend to move a lot slower. They're more reactionary to data, whereas markets and maybe even the staff at times may try to preempt things. So it's important to see that, because I think that is crucial to becoming a good trader. If you can think like a central banker, then obviously you'll be a good trader, right? Now, that's the case in the US. So that is interesting, I would say. Now, when we move to the UK, the UK has been a story of, honestly, data has been varying a lot. And UK also has a bit of this issue, which is that their data tends to be more lagged. Like if you look at the discussion that I just did with the picture on the video of tomorrow's event, if you see retail sales that's coming out tomorrow for US is for the month of October, whereas the GDP data for UK is for September. Now, honestly, you can't blame the central bankers if they're getting data that is a bit lagged. How are they? Because their job is to assess data with the current snapshot of the US economy. But all that they're getting is, I'm sure they may have more advanced analytics, but all that they're getting and the market is getting is 1 month ago. And when you're at the cusp of changes, it is very hard to make decisions when you're getting 1 month lag data. But judging from the fact, it seems that the data in the UK is weakening. Unemployment rate is up to 4.3%, a big jump from last month. Jobs are also down. So honestly, the market is most likely pricing in a weaker number today. Bank of England governor did speak today, Andrew Bailey, but he talked more about the free trade policy and how he hopes the world remains in free trade. So nothing too much on monetary policy, but the Bank of England is skewing a bit more dovish. I have mentioned this in my Substack. It is a pretty interesting thing. Couple of months ago, like a month and a half ago, US was very worried about the labor market and they were ready to cut aggressively, and UK was very worried about inflation and they were cutting slowly. But within 2 months, the tables have turned. Now the US is worried about cutting quickly and will be very measured, whereas the UK may take more aggressive steps, especially if tomorrow's GDP numbers are weak, because they don't want the economy to be weak, especially after, as in addition, Chancellor Reeves also announced a budget that bond vigilantes weren't very happy about. So there's a bit on the fiscal side, but I think right now monetary policy is gonna drive the bus. So I think, yeah, keeping the GDP number could be important. If it's stronger than expected, you could see a bit of a jump, because some of the stuff that was priced in on Tuesday may get unwinded a bit. But if it's weak, and especially if it's a very weak number, if we get 0 or something like that, or negative 0.1, oh, you could see much more selling off in the pound. it may not be good, and a lot more pricing in for cuts. So that's one thing. Equities, I don't know. uh, like you could argue that more rate cuts are priced in, so it's good for equities, but lower growth is never the best for equities, so keep that in mind. But yeah, I mean, that's the situation for the UK. Now, before I end the video, I wanted to talk about the trade updates. As I mentioned, I didn't enter any short USD position yesterday, and neither do I intend to today, even though the technical setup may still look attractive. It's because for an asset that's so tightly correlated to monetary policy, I don't want to short it on the day the central banker of like the head of this Federal Reserve gives a hawkish comment, and inflationary data just seems to pile on and surprise to the upside. Having said that, look at the table on the screen. So this is QQQ, which is a tech ETF. And what I did was I took all the data from its inception in 1999, so till date, so 25 years of data. And what I did was I just checked if there are n positive days or n negative days, consecutive positive or negative days, then what is the probability that the next trading day, the n plus 1th day, would be positive, as well as the expected value? It's just an interesting thing, and I thought maybe there would be a trade here, because although there is a correlation between monetary policy and the stock market, right now we are at a stage where the US economy is strong, and plus the election mania is there, so the euphoria is in favor of long trades. So it could be possible that if the expected value is positive, there could be an interesting setup here. So over the last 4 days, we have had four negative QQQ days. And by negative, I mean today's close is lower than yesterday's close. Doesn't matter what happened during the day. If this criteria is met, it's a down day, it's a negative day. So we have had four consecutive negative days, which means based on historical data, there's a 58% chance that tomorrow would be positive. And obviously the mean win on a positive day is slightly smaller than the mean loss on a negative day, but I mean, if doing simple mathematics, you can find the expected value is 0.05%. And now I know this is not a lot, but given the fact that it has happened on 142 days, this is just a strategy that I've built on the side. I've done this for SPY as well. SPY hasn't fulfilled the criteria, which is why I didn't do anything about it today. But I just have been trying to notch in these trades, and for the most part, I mean, touch wood, the trade has worked. And I mean, the way you work well with expected value is you enter the trade and you make sure that you hold it till the end of the day. And if it's profitable, you enter. And obviously, you have a stop loss so you don't get too hammered on a trade. But I know you might say that, hey, Powell's been hawkish and things like that. But as I mentioned, I think tomorrow's retail sales, if it's stronger, it like the benefit of the strong economic growth may actually outweigh the hawkish worry for the equities, especially tech equities, which have been down for 3 or 4 days, and we might have a slight rebound. So technicals do help, technicals and sentiment. But having said that, I think the expected value demands a trade here. So I've entered a small long position here, obviously with a very respectable stop loss, because I don't want to lose too much money on a trade that's not fully supported by macro. So on the sentiment front and the technicals front, it seems like a decent trade, which is why I'm going forward with it. I mean, this is just one of my analysis, but I mean, I want to keep doing more like these, because in addition to charting, this is another type of technical analysis. And as a trader, you want to make positive expected value trades. And as I said in my welcome video, you got to take some risk to make money. So I could well be wrong tomorrow, but I could be right as well. And the historical data supports it. And I do think that, I mean, after us, QQQ was down, so that's not working in my favor. But I do think there's a chance that a good chance that QQQ could end up positive tomorrow, and I could exit the trade with a decent profit. So that's my trade update for the day. And right as I want to finish the video, for those of you who stayed, this is a small, interesting piece of history, especially because the long end of the yield curve is just rallying in the US. And a couple of weeks back, after the budget by Chancellor Reeves, in the UK as well, it happened. So bond vigilantes are said to be in the market, and these are people, the term was coined in the 80s if I'm not wrong, and these are basically investors and bond traders who in a way sell off their bond positions, especially on the long end, because they are not happy with the fiscal policies of the government. and it's almost like them like demanding a higher yield to hold the bond. And a lot of times what happens is sometimes they don't get what they want, but sometimes when bond vigilantes are very strong, it also forces governments to change. I mean, in the fall of 2022, when Liz Truss became prime minister with high inflation, her finance minister or chancellor of exchequer, if I'm not wrong, he announced tax cuts which are too deep, and the long end of the yield curve just blew up for the UK, and the pound sold off. At one point, the one pound was 1.03 US dollars, if I'm not wrong. That's how bad things were happening. So bond yields were going up and the pound was going down, which is a bad sign for any economy. And as we know it, Liz Truss had to resign within a week or two after the incident, had to roll back the policies, and Rishi Sunak became prime minister and implemented different policies to stabilize markets. But having said that, to illustrate the power of bond vigilantes, something similar happened in the 90s in the US, and people are afraid it will happen again. So, this was when Bill Clinton was president of the US, and his political strategist, James Carville, was warning him about the problems that bond vigilantes could pose. And he said a quote which was pretty cool. And it goes something like this. He said, if I he's like, when I was younger, if I wanted to get reincarnated, I thought that I wanted to come back as the president or the pope. But now, if I get reincarnated, I want to come back as the bond market, because you get to intimidate everybody. So it's like, I know it's a bit of a loaded quote, but I mean, I was also like, what's going on with this quote? But once I studied a bit more about bond markets and understood the power that they hold, I mean, thousands and millions of faceless individuals, all acting in their own self interest, can cause government policies to change. That's what bond vigilantes are. So, for those of you stuck until the end, this is an interesting piece of history. And I hope you found that interesting, and I hope you liked the video today. For those of you who maybe don't have the time or like written transcript instead, you can go to my Substack and see it. It doesn't have the last interesting history bit, so that's there. But yeah, you can look at my Substack, you can look at my Twitter. All of them in the are linked in the description. So that should be good. And hope you have a good day and see you soon. Bye guys.